So this very sharp bear market rally, and yes, we are still labeling it as such, is continuing for the time being. And we've received a lot of questions from people asking us to give you an update. And as always, we are going to look at this through the lens of different parameters. I don't believe you can just draw a line on a chart and call that an analysis. So let's dig right into it. Let's flip the chart and let's have a look at a few things. First of all, just so you guys know, this is straight from the Wall Street Journal. They have this little tracker, which is great, tell you which asset classes are leading and lagging on a year-to-date or quarter-over-quarter basis, or for the quarter to date. And you can see it's still very clear. A lot of the risk-off assets, gold and treasuries, if you look at this, and the dollar index are leading the pack. And then on the downside, a lot of global assets here. Oil continues to be basically bidless, and of course small cap stocks as well, down still 30% from the for the year to date. So the trends really haven't changed in the bigger picture. We still see risk averse assets, at least within the context of the current market environment. Gold and treasuries continue to get a bid. And equities basically just having a bit of an oversold, actually a very strong oversold bounce. So that's just to give you a bit of a backdrop on there. Now, let's have a look at a few different data points to give you a perspective. So what I'm hearing from a lot of people is like, hey, we're going to get a V-shaped recovery, the economy is going to open back up and everything's going to be awesome. I think that's very unlikely, and let me just give you a couple of data points why. First of all, certainly when things reopen, we are going to see a bounce in economic activity. Obviously, from nothing to something is a big bounce. That's just basic math. But here's just a little bit of statistics. You can see that if you look at the past couple of recessions, so the year 2000 recession and the financial crisis we had a decade ago, it took 48 months and 76 months respectively to get back to the previous employment levels, right? So considering that the U.S. economy is 70-ish% consumer driven, unless people are back to employment, I don't know, to these employments, I don't know how you can get back to the same valuations in the market, the same economic activity levels we've had anytime soon. This is going to take time. In addition to that, what's interesting to note, and I just found this yesterday, this is from Deutsche Bank, really interesting. You don't have to look at it too closely, but it's you can see more or less what it's trying to tell you. The interest rate on auto loans, like car loans, is actually higher now than it's been for a long time. So with people losing their jobs, a lot of people won't be able to even pay their car loans, right? So this is it's all kind of one picture to tell you that yes, we're going to see a bounce in activity once things are back, but we're not going to go straight back up to the previous high in activity, and thus also very unlikely for the stock market to do the same thing. One thing that continues to be a problem for me is what I see consensus believing, and this is a statistic now from a couple of weeks ago, and I've posted this on Twitter. I may have even mentioned it on YouTube before, but 2 weeks ago, people really thought that April was still going to be the bottom for equities, and this is a massive consensus, relatively speaking. Now, maybe the numbers have shifted a little bit, but I think more or less that's still what people think. Or maybe it was even March at this point. People think March was the low. I'm more in the camp that maybe over the summertime at some point we see a low, maybe even in the fourth quarter. So this is just what I'm trying to tell you, that the consensus has a very strong view, and I'm not quite sure consensus. A lot of times consensus isn't right, I guess is my simple point. Now let's talk a little bit about leverage, since we just talked about credit before. This is really interesting. This is telling you that the Russell 2000, which is the black line, has a lot of debt. Like, I mean, we know that small cap companies have more debt than large cap companies, in relatively speaking, right? But they're now more than twice as much levered almost as they were before we went into the financial crisis in 08, 09, right? That's against the black line, more or less. And that's a problem, because again, with consumption not coming back to the point was because people they're not going to get their jobs back right away. And obviously some people are going to get their jobs back right away. In fact, probably a lot of people, but definitely not all of them, not even close, right? And this all ties into the problem that, again, we're not going to see economic activity ramp right back to the highs. We're going to see more something like a square root, right? Where like you have a sharp drop, then you have a bit of a rally as things come back online, and then we kind of flatline for probably an extended period of time. And I think it's not going to be that different for equities. Equities will be more volatile, but I think that's kind of what we're looking at. So what does that look like in terms of indices, and you know, what are some simplistic lines we can draw on charts? Well, if you look at the Russell 2000, and I'm going to give you a couple of charts on this. This is the Russell 2000. I'm going to not look at the S&P right now for a second, because the Russell gives us a cleaner view of this and probably a fair picture, if you will. And you can see the Russell broke its long-term downtrend here in March, uptrend, excuse me. Now it's rebounding to a classic area of resistance. Now again, you have to give this some time, some room for error to the upside, to kind of where it might find exact resistance. But I think after a 30% rally, you know, and by the way, the Russell is still down 30% since the February, January highs, lower highs, I should say. The absolute high was in 2018. You know, it's to me as good a spot as any to initiate some short positions. On the short term charts, you can see this is what the Russell 2000 looks like. On the daily chart, you can see we're bouncing right back to resistance. There's a bear flag if you like to draw bear flags on charts, which again is a good thing to do, but unless you have the context, it's a useless exercise. But I think this is interesting. Now quickly, because I'm sure everyone wants to know, what about the S&P 500? Well, the S&P 500, one of the things that we continue to reiterate to our clients, and I'm pretty sure I've also mentioned it here on the YouTubes, there is technically room all the way up to that 61.8% Fibonacci retracement level. That is, if you take it from the highs in February 19th down to the lows on March, March 23rd or 20, something like that, we've now reached a 50% retracement. We could go towards a 61.8. We could even overshoot a little bit there. So we're talking about an area between 2,900, you know, to possibly as high as 3,000. It's not at all out of the question. Why? Why is the bounce so sharp? Because of the magnitude, not only the magnitude, but also the speed of the drawdown we had in the second half of February into the first half of March. It was not only one of the steepest moves, certainly the quickest with that much depth, right? And so when that happens, you're also going to get somewhat of a relatively corresponding bounce back that's equally strong, right? So we think we're getting, obviously, again, this is a silly thing to say, but much closer to seeing another leg lower here than we were, you know, obviously 2 weeks ago. Again, it's a silly thing to say, but statistically speaking, you have to kind of think that way. But again, I think anywhere between where we are right now here as of this recording, maybe up to the 61.8% retracement. So again, between 2,900 and 3,000 on the S&P is probably where we could find resistance. We haven't seen any bearish confirmation yet to the downside, but we think we're probably rather close to seeing that. So anyway, folks, I hope this is helpful. As always, if you have any questions, comments, leave them down below. Give us a thumbs up, like, subscribe, all that good stuff. Let other people know about the channel, and we'll see you guys soon.